Today, I wanted to talk about Hertz rental cars and their recent earnings report. We saw a big spike in the stock, and I see a lot of investors wondering, is now a good time to buy, hold, or sell? Potential short squeeze, what's going on? So let's dive right into it here, guys. So I'm sure all of you already know this, but if you don't, I just wanted to highlight Hertz rents out cars. You pay them a fee to rent a car, usually this summer being Q3 is their busiest business. They've been in operations for over 100 years with over 26,000 employees. They do 25 million rentals a year and are about $9 billion in size and revenue. And it's very interesting because in the recent quarterly earnings report here, the company became profitable again for the first time in 2 years since exiting this bankruptcy scenario. And here's the headline that sent the stock spiking today was that Hertz Global Holdings Q3 adjusted earnings per share of 12 cents beats the 2-cent estimate, and the sales of 2.47 billion beat the 2.4 billion estimate. So they beat estimates here on earnings per share, revenue, and became profitable for the first time in 2 years since the bankruptcy. So I have a table to the right here of the global Q3 results year over year. And one thing I want to preface it with is that when you look at it sequentially from Q2 to Q3, you're going to see a revenue increase. But when you look year over year, you're going to see that revenue decrease. And I just want to remind people, that I hope they realize that the company is usually very seasonal, right? That 3Q renting cars in the summer is their best season. And this quarter is really not substantially better or worse from a revenue perspective, but I will add, and that's why I have the chart here, three main things I wanted to point out to you was that revenue decline, right? You can see from Q3 24 to Q3 25, right? We want to hold those summer months equal. We don't want to look Q2 to Q3. You're going to think the company's growing. It's very seasonal. There's a lot of seasonality here in the stock. So they declined revenue by 4%. And the other two I want to catch your attention to is the adjusted EBITDA, finally went positive, but even more important in my eyes and very impressive. On the quarter, 248 million in adjusted free cash flow, which puts them just about on track for $1 billion in free cash flow in a year. And you can see the commentary to the right that they attributed this increase of about $400 million in adjusted cash flow by a combination of profitability improvement and the increase in effective vehicle funding advance rates. And I see the stock's name catching a lot of traction here on X, on Stock Twits, and I see this picture looming around about their short interest, right? I mean, this company was in bankruptcy. They weren't profitable for the 2 years after the announcement, but they just turned the tables on them, right? So short interest here is at 44.3%. I mean, that anything over 10%, you're in for a battle against some hedge funds here. But I mean, 44% is a very high short interest. So I think it's always interesting to see what super investors buy. And Bill Ackman's very infamous, and he's a value investor. I'm on the fence about him though. Sometimes, this guy's called the last 30 of the last four stock crashes. So, but it is interesting to see because he is a value investor primarily, and he took earlier this year a 20% ownership in the car rental company Hertz here. The potential for auto tariffs. This is his bull thesis, being that the potential for these auto tariffs to significantly increase the value of its large fleet of vehicles. And, him believing in Hertz's back to basics operational turnaround plan, where they did just turn positive, for 2 billion. So he did have that foresight to see it. He also sees potential in other strategic areas. Their potential partnership with Uber and the potential to improve operational efficiency and profitability across the company. And a big part of what Hertz does is the cyclical capital expenditures, right? They need to renew their fleet every 3, 4, 5 years. And that is a massive capital expenditure. So to kind of help offset, right, the purchase of all these new vehicles, they sell all of their old vehicles. Well, they announced a partnership recently with Amazon here where now you can buy one of Hertz's rental cars certified pre-owned right from Amazon. And I mean, I think that should definitely help them offload some of this inventory to kind of offset these future capital expenditures. I mean, you could see when they were renewing their fleet in the last 2 years, they're like 80% of revenue, 60% of revenue is being spent on these capital expenditures. So, the ability to sell this fleet with Amazon and get, Amazon has so many eyes on their website and people, will be able to buy a car now off Amazon, I think is very positive for Hertz Rentals. So I just wanted to pull up the income statement and look at two quick things here. I wanted to look at revenues and I wanted to look at the gross profits, right? The revenues you could see, have taken a serious decline since 2023 here from 9.3 billion to 9 billion to 8.6 billion. And as the revenue, continues to decrease, unfortunately, the gross profit margins have been collapsing, right? If you look at 2021, they had almost 40% margin, 37% margin, 20% margin, negative 2.3% margin, and now they're on track to build it back up to 6.5%. So you could see it trending in the right direction, but 100% a turnaround play, and they still have a lot of kinks to iron out here. And here's the asset portion of their balance sheet. And again, I just wanted to kind of point out two things. Cash, they only have 500 million on hand. And you'll see in the next slide how much debt, just the towering debt. I mean, it's coming to like $1.2 billion expense a year in interest alone, not even paying off principal. They are plagued with debt. And their only real asset here is the other long-term assets being their cars, which, Bill Ackman is saying, these are marked at cost, right? So in an area where tariffs are solidified, the prices of these cars can move up substantially. But I mean, you're about to see in this next slide, this debt is scary. And here's the liabilities portion of their balance sheet. And I really just wanted to show you the debt piling up at the company, which makes sense exiting right at bankruptcy in a company that's not profitable. They either have to dilute shareholders or they have to take on debt, right, to keep these doors open and business operating. So taking a look at the balance sheet here, total long-term debt 5.4 billion, finance division debt 11.4 billion, put us right around 16 billion, and you know, it's just a lot. It's a lot of debt. I mean, I think the company has a market cap of around 2 or 3 billion. So I mean, we're talking 5x. I mean, how private equity company would look at it from the perspective of, we accept elevated levels of debt, of course. How can they handle it? And well, what's the relationship to debt to equity? What's the relationship to the interest coverage ratio? If we look at debt to equity here, I mean, they have about 16, 19 billion in debt and they have negative equity. And I mean, negative equity happens from, you can see that huge retained earnings loss that's just been piling on since 2020, right? Retained earnings means you lost income. Net income was negative for those periods. And it's just hammered away and ate all their equity up. I mean, look, they were at 1.3 billion dollars in equity and they've dwindled down to negative equity. So I mean, how this company's not producing net income, you can see they have no retained earnings, right? They're not retaining any of their net income. Uh, and they keep pulling on debt and debt and debt. So I get that the company just became profitable. That's beautiful. What is that reflected as an interest coverage ratio? How much time does your earnings cover the interest payment? And a debtor would like to see something in the 3 to 4 times coverage ratio. I mean, I think these guys are not even at 1 times coverage right now. So the positive they have been working on, right, is that they're generating cash flow to some extent now, right? Disregard net income, disregard EBITDA, we care about cash flow here, what's coming in the door, what we can spend our money on, right? Not these fake depreciation expenses. Anyway, if you look at cash from operations, the bottom line here, right, just from their core operating business, how much money came in, less how much money went out the door. Okay. And they're positive. I mean, they're 5 years, 6 years positive in a row on cash from operations, which is beautiful. You like to see. My problem is the debt. They are just so plagued right now. It's ugly. I mean, other than that, I think this would be a really good opportunity. But you're going to see how even them generating this cash flow, they're just drowning in debt. All of it's going to be gone in the next slide. All of it. And you'll see. So here we go, right? You can see the capital expenditures, the first line after cash from operations. And you can see how much they had to spend in 21, 22, 23, $4 billion every year in getting this fleet up to date. And it starts to dwindle out and normalize in 24 and 25, but it's cyclical, right? It's gonna happen again. And that's okay because they can offset that when they sell their cars, right? Through especially through Amazon now with that greater visibility. But what I'm more worried about here is you see the debt being issued right below cash from investing. They got issued $19 billion in debt in 2021. Okay. And every year after, they still are pulling on 9 billion. That's how much they make in revenue a year. 9 billion. Okay. And they are pulling more than they are in revenue to keep the doors open. I mean, dude, that doesn't even make sense. Okay. Go down the line to total debt repaid. It's plaguing them. I mean, remember when we were showing positive cash from operation results in the last slide? Well, look at it all now, man. It's all going to CapEx, and whatever hasn't gone to CapEx is going to our debtors. I mean, it wipes us out. Look at the free cash flow line in the bottom, minus 2.6 billion, minus 1.7 billion, minus 1.7 billion, minus 700 billion. Oh, and positive. We're on track right here. We just got the update to be positive, but even still so with how much debt they're adding and servicing, we'll look at it from a DCF perspective, but I don't see how they ever make their way out of this without refinancing. I mean, the key to this is a refinance. It has to be done in my eyes. And just to try to look at this mathematically, I mean, I just am not envisioning a scenario where the free cash flow exceeds the debt that they currently have. Um, I'm using analyst projections here, the industry growing, 25 analyst projection, 26 analyst projection. And then I'm growing at 3% a year from industry reports saying where it can go, and that's assuming this company's able to turn it around. Remember, they just had a minus 1% decline in revenue from Q3 24 to Q3 25 here. So, these are kind of more not as conservative assumptions. And the free cash flow margin, they're basically announced that they're on track to hit just about $1 billion in free cash flow. And I know there's the seasonality, so I gave them credit only for 950 million instead of the full billion, kind of still not a super conservative assumption, which would land us at about an 11% free cash flow margin. So let's just assume they hold that 11% free cash flow margin true all the way through from now until perpetuity, right? I think if you look at Avis and you look at Enterprise, I mean they're topping out. They're in the 9 to 13% free cash flow range. Free cash flow has been dropping across the board. I do think there's more competition coming up from Toro, and it's kind of hard to compete with Toro, right? Because they don't have to buy the cars; they're kind of supplying their own fleet there. But anyway, um, so looking at the free cash flow margins here, we can times the revenue by the margin, we get our free cash flows, and then we're going to divide that by one divided by one plus the discount rate raised to the time period minus a half to account for that mid-year period convention. Then we're going to get the present value of our cash flows, and like always, the bulk of it's coming into perpetuity. So I mean, I'm assuming this company can reach 10 billion in size and 11% in free cash flow. Gives us 11 billion in perpetuity, but then, perpetuity to now is a long time. The cost of a dollar today is worth more than a dollar tomorrow. So you discount that almost by half here from our calculation. And that gives us the sum of the present value of all cash flows to be 10.1 billion. Company is 19 billion in debt. I don't ever see them overcoming this, and I need to see more before I invest, but I do think the news is positive of them, increasing their profit margin and breaking even here. So in my eyes, I had this on my watch list, which may surprise you from my DCF, or I mean, if you're even still here watching. But I think it's important, right? Because I have it on my watch list because I think the refinancing is key here. The Fed is coming up in December. They might drop rates. They might continue to drop rates through 2026, which is really going to help a refinance situation here for Hertz. I mean, if they can hack away at this $19 billion of debt, and especially lower the rate at which they have that at, now we're talking. Now I'm seeing some value. But as it stands today, man, I need news of a refinance for me to really be interested. So that's all I have. Hope you guys got something out of it as always. Take care.